Hi, I'm Rebecca Pope, Head of Intermediary for Vanguard Australia, and welcome to our webcast on factor-based investing. Today I'm joined by two of Vanguard's most experienced equity investment experts who will offer some invaluable insights into how factor-based investing can make an active difference to your clients' portfolios. First joining us is Mike Roach, Vanguard's head of the Australian Quantitative Equity Group, and we also have Alla Koganova, who is a principal in our investment strategy group. Between them, Mike and Alla can bring a real hands-on perspective to the way that factor-based investing can transform your clients' portfolios. Thank you for joining us, Mike and Alla.
Thank you, Rebecca.
Thanks for having us.
Before we begin, I'd like to remind you that the webcast will run more efficiently if you close any other browsers you have open on your computer. We'll also be answering your questions today, and we encourage you to continue to submit more questions throughout the webcast. Thanks to everyone who submitted a question ahead of time. We've chosen a few that represent some of the most frequently asked topics. So let's get started. Mike, given the advisors in Australia are more familiar with Vanguard as a provider of index funds, could you take a minute to walk us through our history in active management?
Sure. Well, I think first to point out that a common theme across all of Vanguard's portfolios is a focus on low cost. And for the first 22 years of our Vanguard Australian business, that has been delivered in the form of passively managed index tracker funds. But if you look at the history of Vanguard, we have a deep-rooted experience managing actively managed funds. You could track that all the way back to the founding of the Vanguard Wellington Fund in 1929. Today, over 30% of Vanguard's assets are managed actively, which is about $1.5 trillion. Specifically, my group, the Quantitative Equity Group, has been managing active assets for Vanguard since 1991. Now, the ability to offer our actively different brand in the Australian marketplace today has really been brought apart by the globalization of our investment management framework. So today we're able to bring those efficiencies and scale that Vanguard has been providing globally to the Australian marketplace. And as we focus on factor-based funds, it's really just another example of how we've continued to be able to offer more products at a lower cost, allowing investors the best chance for investment success.
Great. And, over the years, there's been a lot of debate around active versus passive. It would be great if you could share your perspective on this.
Yeah, for us, it's really not about active versus passive. It's how you can use active and passive together in a diversified portfolio. Now, Vanguard still believes that a market cap weighted, broad-based index fund is the best place to start from an investment standpoint. But if active is done right, focusing on the long term, emphasizing lower cost, it can play a critical role in helping investors with unique objectives to meet their goals.
And I guess now moving on to factors, Alla, can you tell us a bit about factors and why they are important to consider as part of a client's portfolio?
Over the last few years, we've seen increasing and growing interest in factor-based investing. To some degree, it is a part of a larger trend moving away from the high-cost active fund management, which struggled to add value over many years, towards the low-cost-based investing. Factors themselves, of course, are not a new concept, and portfolio managers have been providing investors with exposures to stocks with such characteristics as momentum, value, quality for many decades. For example, value have been discussed by Graham and Dodd in their famous book Security Analysis in 1934. What is new now, it's technological development which enabled investors to get a really good understanding and insights in factor exposures within their existing portfolios. And with the insights brought up by the performance analytics tools, investors are now understanding that what has previously been perceived as just manager alpha could often be explained by the static factor exposures and a return to these exposures in their portfolio. So investors are starting to question the high cost active management and the value it brings, and see if they can substitute or replicate these factors exposures in their portfolio with low-cost factor-based products.
Right, and we get a lot of questions from advisors asking about Vanguard's approach to factor investing. Mike, perhaps that's one you can address for the audience.
Yeah, well, we find that factor investing can be most efficient when you focus on weighting these securities by their exposure to a given factor, which is really different than a broad-based market cap weighted index approach. So the starting point is that factor investing is active. Even though that many of some of the early products in the marketplace were delivered in a passive index framework, these funds are taking a bet against the market. They're going to have higher tracking error, different return patterns, and Vanguard feels that these products should be labeled as active and then measured as active funds. Additionally, given that the framework of these active funds is active, we find that there are huge synergies to be able to implement them in an active fashion. Now, we're still offering the same benefits of Vanguard index-related products of transparency, a rules-based methodology, and low cost, but that active framework, we're able to add in the ability to better control our factor exposures while controlling cost and transaction cost.
Mm. And, we know that literally hundreds of factors have been identified by researchers. So, a question for you, Ella, how does Vanguard approach selecting factors?
You're right, Rebecca. In academic and industry literature, hundreds of different factors and stock attributes have been researched over many years. And generally speaking, there are two main type of factors that drive investor returns. One type is macroeconomic factors, with which we're all familiar. It's factors like economic growth, inflation, real interest rate. On the other hand, it is investment style factors like value, which we discussed before, quality, momentum, volatility, liquidity. Here we are focusing on investment style factors, and when we're considering specific factors for our factor products, we're looking at the three key elements. First of all, we're looking if there is an enduring rationale, whether it is a risk-based or a behavioral-based, for the returns to persist in the future. Secondly, this rationale should be supported by empirical evidence, and we look at the performance over many market cycles and market conditions. And thirdly, because we are specifically focusing on factor products rather than theoretical concepts, we are assessing the investability of the factors, taking into consideration all trading and implementation costs.
Mm. And I guess, considering that there are so many factors that have been identified, why did we choose value and minimum volatility factors as the first factor funds and ETFs to launch in Australia? Mike, perhaps that's one for you.
Yeah, well, I think balancing investment merit with product demand is always a bit tricky. But if we focus on those key elements that Ala was just talking about, we think we're able to hit that investment merit standpoint. These are products that we feel have long-term potential to add value to a client's portfolio. But also what's going to resonate in this marketplace for us. And we thought that for Vanguard, again, is having a history of running index-based products, starting with a factor-based, rules-based approach would be a good first entry to Vanguard Active within the Australian marketplace. Specifically when we look at value, again, it's value is a concept that is well known, well researched, well accepted. It's a targeted exposure in many client portfolios today. They just happen to be getting that in a high-cost active framework. So if we can offer an alternative there, give them value exposure, low cost, again, we're helping to increase investors' chance for success. With minimum volatility, it's more about maybe what was a kind of a gap in the marketplace. We're finding that investors have increased longevity risk or different concerns about risk. So if we can give them a product that's explicitly designed to help further diversify their portfolio. And we see strong applications across an investment life cycle for a fund like minimum volatility, those in accumulation, and more importantly, those in a pension withdrawal phase.
Right. And, we've had a number of questions come in during the webcast, specifically around how do advisors implement factors in their clients' portfolios. Ali, can you possibly share some insights on this?
Yes, it's probably worth noting that, as with any other investment, it is investors' unique set of objectives, constraints, and also risk tolerance, which will determine how they might use factors in their own portfolios. But generally speaking, the factor funds can be used in a number of portfolio applications. We touched on one of them a little bit before. It's a substitution of active management. So if an investor believes that most of the active returns delivered by their manager comes from the static factor exposures and not from the security selection or market timing, then they might choose to substitute this manager with combination of the index fund and also a low cost factor product to replicate the active manager returns. Another example would be return enhancement. So, like for example with value, if an investor believes that the factor will continue to outperform in the future and they would like to enhance the returns they're currently achieving, they might choose to tilt their portfolio towards this factor.
And maybe to add on, slightly different from the return-based perspective, is focusing back on risk. So if we think about just risk reduction, it kind of come back to minimum volatility again, where again this is a portfolio designed to help diversify a portfolio, still allowing an investor to get equity-like returns, but reducing their risk. Historically, the alternative may have been the switching to fixed income, and there could be valid reasons why an investor maybe does not want to make that allocation. They still want to stay in equity, but they're concerned about the long-term risk. Another side of that is focusing on calibration. So an investor may have a heavy exposure to an active manager that has a growth-oriented tilt. And they believe that manager can add value over time, but they're not comfortable with the overall risk of their portfolio. So here they can add an allocation to value to help balance that out. Another way for calibration could be tied to maybe an investor wants to they have a viewpoint on emerging markets. But again, that's going to add some risk to their portfolio. They can balance that out with minimum volatility to keep their total projected risk in a similar fashion, but still express kind of a long-term tilt.
And so thinking about performance, how has factor-based investing performed against the index?
The answer to this question depends on how we define the performance and also on the time frame we are talking about. So if we take, for example, a value investing, value on average outperformed the market on a long time frame. But it also had quite a long stretches of underperformance. For example, during the tech boom of 1990s or during the GFC. So it is critical for investors to understand their own ability, willingness, and also time horizons to be able to manage these stretches of relative underperformance.
Yeah, maybe to add to that, performance, in a total return framework is one objective, but for some investors it could just be they want exposure to value. So managing success is more tied to what is the level of exposure that we can provide, and we think our framework of weighting towards a factor, not the market cap, is going to give you a deeper exposure, greater chance of success of your objective. Another objective is risk reduction. So with minimum volatility, it's not just about performance, return relative to that index, but did it provide you less volatility than that broad market? Mm-hmm. So just to echo Ali's points, for each investor, success is different, and it has to be tied to an objective.
And what about applications? Is it rule-based or dependent on human analysis?
Well, we think for these products to be successful and to be understood in the marketplace, there is a high degree of transparency necessary. Following a rules-based process are going to allow investors to be more comfortable with these frameworks. And I mentioned before, there are a lot of similarities to how we implement passively managed index products. But they still are active. They take bets against the market. So by implementing them actively, these funds are not tied against an index reconstitution, which makes perfect sense in a market cap framework. But when you move to something that's closer to equal weighted, you have to be more thoughtful in how you use turnover, how you can maintain exposure to your targeted factor, and we can better do that actively. These products, we're going to have a more consistent exposure, and you're not going to see a decay that you may see if you were following a factor-based framework in an index portfolio.
Okay. Well, unfortunately, we're almost out of time, but just to close out the day, we'll take one more question. And Mike, this one's for you. Could you share with us what you see as the next opportunity in factor-based investing?
Yeah, so I think most of our conversation today was focused on single factor portfolios. We mentioned value and minimal volatility, and we have capabilities in other single factors that we think meet the same kind of investment criteria. They can add value over the long term. It's momentum, quality, liquidity. But there has been a lot of interest in a multi-factor portfolio framework. So I think a lot of investors are more interested in how you aggregate these factors in a thoughtful manner without having them kind of cross each other out. So it's something that we continue to research. We do have capabilities in other markets that are closer to this space. But again, for us, it's what is the demand versus what's the strong investment case.
It certainly sounds exciting. So thanks, Mike and Ella, for your great insights today. And thank you again to all of you for all your great questions and for taking the time to log on. Hopefully you found the discussion beneficial, and if you'd like a deeper dive into factor-based investing, we've got plenty of great information on our website. Before we wrap up, I'd like to remind you that the webcast has been accredited by the FPA, and you can receive CPD points by clicking on the survey tab to the right of your screen. This survey also gives you the chance to provide any feedback and offer suggestions about future topics you'd like to hear about from Vanguard. Enjoy the rest of your week, and thanks again for your time.